Hello, my name is Patrice Poulin, and I'm a PhD candidate at National University. This is a short introduction on the core principles and applications of corporate finance. For today's discussion, I'd like to use the role of the CFO as a framework to discuss three main topics, namely investments, risk management, and capital financing. So what is the role of a CFO? Well, my understanding is based on Michael Jensen and his book, Organization Theory and Methodology. It dives into the agency theory, which explores the dynamics of conflicts of interest between, on one side, the principal of a company, like the shareholders, and on the other side, the agents, like managers and executives. Figure 1 shows the four buckets of responsibilities of a modern CFO, and today we will speak about the first three. The fourth one, financial reporting, is typically covered during accounting courses. More specifically, today we will talk about methods for assessing projects during resource allocation decisions. We will talk about metrics of diversification to address risk, and we will look at capital funding options and their costs. Let's take a look at evaluation methods. Albeck and al. Talks about different approaches for evaluating potential investment projects, as outlined in figure number 2. First, the net present value method looks at future cash values and discounts back to present value under the premise that $1,000 today is worth more than $1,000 in 5 years. However, the key challenge lies in determining which discount rate to use and whether or not each project should use the same discount rate. But that's a topic for future discussion. The second method, the internal rate of return, is arguably the most straightforward and intuitive method comparing project returns against initial investment to compute a percentage return on investment. However, this method overlooks the project scale, and larger projects, which are typically associated with high risks, may not yield all of their anticipated returns. Luckily, new models have been introduced to account for project risks, but that's also a topic for a future discussion. Lastly, the payback method assesses how swiftly the initial investment can be recovered. While projects with shorter recovery period are typically preferred, it's by itself not sufficient to make well-informed decisions. Various researchers, including Guo and al. 2018 and Grzycki and Waskovich 2020, have investigated the optimal use of these methods and developed decision-making frameworks to assist CFOs and financial managers in making informed investment decisions using multiple criteria and more advanced methods. Now let's talk about diversification metrics. In the context of financial risk management, understanding the difference between measures of dispersion and covariation is crucial for managing risk associated with investment. Figure 3 illustrates the way I see different measures of diversification. First, dispersion metrics quantify the spread of variability associated with individual assets or investment. This includes statistical measures such as the variance and standard deviation. Second, we have the covariation indicators, which provide insights into the diversification of combining assets into a portfolio. This includes metrics such as covariance and correlation. Let's take an example. Imagine an investor evaluating two stocks, stock A and stock B. They analyze the standard deviation of returns for each stock to gauge their respective risk level. Furthermore, they compute the covariance and correlation coefficients between the two stocks to grasp how closely their returns align. And the high correlation coefficient suggests that they have synchronized movements between the stocks, whereas low correlation or even negative correlation suggests that potential diversification advantages within a portfolio settings. And on to the cost of capital. According to Modigliani-Miller theorem, dating back to 1961, the capital structure, which comprises of debt and equity, has no impact on a company's value under perfect capital market condition. This implies that the right-hand side of the balance sheet does not affect the value of the firm. In reality, though, tax deductions on interest payments incentivizes firms to borrow from banks for financing. But excessive borrowing can raise the risk and bankruptcy potential, prompting firms to seek capital from the stock market investors instead for diversification, as illustrated in figure 4. So it's a balancing act. Both financing avenues play vital roles in corporate finance. Generally, CFOs prefer bank borrowing over stock issuance within reasonable limits because of the tax advantages. But determining the optimal debt-to-equity ratio could be the topic of a future discussion. In conclusion, I hope this short introduction provided some good insights into the challenges of modern CFOs. Obviously, there's a lot of calculation, a lot of regulations involved in finance, but there's also an art to it, which comes from experience. Here's the list of references for this week's assignment.